Welcome, everybody. Thank you so much for joining us for today's webinar, Valuing Corporations from the Bottom Up, sponsored by the Emory Alumni Association. We appreciate you taking time out of your day, whether you're at lunch here on the East Coast or maybe just getting into your day on the West Coast. Thank you for taking time and being a part of the Emory Alumni Association. My name is Lane Conville-Canny. I'm the Senior Associate Director of Alumni Learning. I'm thrilled to be joined by Dr. Dan McCarthy, who's the Assistant Professor of Marketing at Emory University's Goizueta Business School. Today is the first day that kicks off our commencement activities, so this is a very exciting time to be at Emory and on the Emory campus. It's a beautiful day in Atlanta, and a lot of graduates are getting ready to walk across the stage and walk into their lives. So we're excited to be here and a great time of year. Just a reminder, today's presentation is being recorded, and you can access the recording on Emory University's YouTube channel. We have over 100 past career webinars on a variety of professional subjects, so please do check those out after our webinar. I'll be sending a link out so you can see all the different subjects that we're offering. Thank you so much for registering. If at any time you have to walk away from this live webinar, don't feel bad. We'll be sending the full recording out to you. We hope you stay and can engage with us and submit any questions to Dan throughout the presentation using the question or chat box. As the presentation goes along, as the questions come in, we'll be asking Dan, so feel free to send them during the presentation, and then if we have time, we'll add some more questions at the end. A bit more about our presenter. Dan McCarthy is an assistant professor of marketing at Emory University's Goizueta Business School. His research specialty is the application of leading-edge statistical methodology to contemporary empirical marketing problems. He popularized customer-based corporate valuation, CBCV, a methodology that drives any traditional valuation model off of the underlying behaviors of the target company's customers. His work has been featured in major media outlets such as the Harvard Business Review, the Wall Street Journal, Fortune, Barron's, Inc., Magazine, The Economist, and CNBC. His research has been accepted and published in top-tier academic journals, and he's won numerous research awards. In addition to his roles and responsibilities at Emory, Dan has co-founded and was chief statistician for Zodiac, a predictive customer analysis SaaS firm. Nike acquired Zodiac in March 2018, and Dan has since founded Theta Equity Partners to revolutionize how firms like private equity, venture capital, and operating companies directly value companies through CBCV. Thank you for joining us today, Dan. I'll turn it over to you.
Great. Thank you very much, Lane, and it's very good to be with you. I'm really excited to share kind of the latest work that I've spent the past 4 or 5 years pretty much solely focused on this topic. And I think it's just kind of a joy to be able to share it with you here today, especially as Lane was saying, as the latest batch of students goes on to the greener pastures and the next batch of students is coming on in. So definitely a great time to be talking about this work. And as Lane had said, just a little bit of background about myself. I've been here for about 2 years, really enjoying my time at Emory. And I'd spent the previous, call it 6 years, working at a hedge fund before I went back for my PhD at Wharton, formerly in statistics. And it was in the second year of the program that someone said, you should speak with Pete Fader. He's a marketing professor, but he is just as much of a statistician as I am. And we really kicked it off. As Lane had said, we co-founded Zodiac together. And kind of through that experience, I had the ability to kind of run the sort of models that I'll be talking about today on a couple of hundred companies before we were acquired by Nike. And since then, the following month after the acquisition, that was when Pete and I co-founded that second company, Theta Equity Partners, to really focus in on this use case of customer-based corporate valuation. So again, that's exactly what we'll be talking about today, and that's exactly why, hopefully this should be really interesting and exciting for you, because hopefully I should have perspective both from the academic side, having built kind of the frameworks and theory and models that is more suitable for academic journals, but then also bringing it to life by doing this sort of exercise for private equity firms and for hedge funds. So without further ado, I am going to go off the webcam and just focus purely on the presentation slides. So today I'll be talking about, again, it's called CBCV, customer-based corporate valuation. And kind of at its heart, what it represents is kind of a relatively humble statement that if we have the ability to predict what a company's customers will do, that's telling us something about how much revenues the company is going to be able to generate in the future. And that's going to help us better understand what companies' valuations should be. So, oftentimes I've found that companies will have, say that we're looking at a private equity setting, and a private equity firm is looking to potentially make a control investment in a particular target company, and they'll kind of use, they'll go to the traditional financial statements, they'll speak with the management team, but they'll have this big CRM database and all the transaction log data just kind of sitting there unused. And basically what we would say is there's a treasure trove of information in that transaction log. And for public companies, like I'm going to share with you today, if they disclose metrics about their customers in the filings, that can give us a similar read on the underlying state of the unit economic health of those businesses. And that's really what I've spent the past 4 or 5 years building methodologies to harness. So yeah, just to kind of recap, if we were to break down the value of a company's equity, if you were to open up a corporate valuation textbook, it would typically break it down into 3 main pieces: the operating assets, the non-operating assets, and the net debt. And those latter 2 pieces are very straightforward. The net debt, you can actually pull it pretty much right off a company's balance sheet. The non-operating assets is anything where if we took a grenade and just blew those assets up, obviously the company would feel bad about it, but it wouldn't affect the company's ability to generate revenues and have those revenues flow through into profits. That's all that third leftmost box represents. It's basically typically the most important source of value for a firm. And again, it's all about how much revenues is the firm going to generate and how much of that revenue is going to flow through into profits for the firm. And so obviously it's going to be driven by all sorts of factors like the effectiveness of the sales force, any patent protection the firm might have, R&D assets, etc. But the fundamental claim that I would make as a customer-based corporate valuation advocate is that underlying every single dollar of revenues that a company that is customer-based is going to generate, there's a customer who's making a purchase. So tell me some information about those customers, and I can tell you something about what those operating assets are worth that I would not have been able to tell you if I did not have that information in my model. So what CBCV is all about is explicitly linking financial valuation, whatever methodology you want to use, whether it's DCF or a multiples method or what have you, to the underlying drivers of unit economics, specifically the following 5 kind of key customer-based drivers. Customer acquisition, so how many customers am I going to bring in the future? How much am I going to have to spend to acquire those customers? How long will those customers stay with me? How many orders are they going to place while they're kind of maintaining their relationships? How much are they going to spend when they make orders? And what is the variable profitability of each of those incremental revenue dollars? And you tell me those things, and I can give you a much more refined view of the attractiveness of a potential investment. And if you tee it up with all the usual kind of other financial drivers like fixed costs over time, working capital adjustments, and obviously estimating the firm's cost of capital, that's what gets us to the company's fair valuation. So I thought it'd be helpful just to kind of take a very simple example. Imagine that we're thinking about a company and we're looking out over the next 3 quarters. The first thing that we'll do with the CBCV approach is model and forecast the evolution of the total size of the customer base. So in Q1, we're going to acquire some customers, and that leaves us with our customer base at the end of the first quarter. Now, the number of customers that I have at the end of the second quarter is basically going to be the number of customers that I'm able to bring in the second quarter, plus the number of customers that I'm able to retain that I had previously acquired in Q1. And so one of the kind of core statistical prediction problems that we have to do is basically model and forecast the evolution of future customer acquisitions And then after those customers have been acquired, another statistical model to forecast how long those customers will maintain their relationships with the firm until they end those relationships. And so I'm going to use kind of models that are very time tested within the actuarial sciences, but instead of predicting the mortality of humans, I'm going to be predicting the longevity of relationships and the amount of time that elapses until customers are acquired by the firm. Now, if you gave me the number of customers that a company has at different points in time, and I also knew the company's order rate and their basket size, that is basically, there's an accounting identity here where that has to give me the amount of revenue that the company is going to generate in future quarters. And then if you gave me the company's contribution margin, how much they're spending to acquire customers, and then their fixed cost base, and then make some working capital adjustments, that has to get me to the company's free cash flows. And if I discount those back and do all kind of the standard things that one would do for DCF financial valuation, that's what gets me to the fair valuation of a company stock. So again, DCF is about as standard as it gets when it comes to corporate valuation. We're basically saying we're going to leave that model as it is, but the only thing that we're going to do is try and predict a few of its drivers a bit better by incorporating some statistical methodology to better model the customer behavior. So hopefully that makes sense. So rather than just kind of keep this all very theoretical, I thought I'd bring it to life with a few examples. The first is going to be Blue Apron. They're obviously a subscription-based company, and they're one of the earliest examples that really kind of popularized the CBCV approach. Then I'm going to go to a couple more recent examples. The second one's Farfetch. So they're an online luxury apparel company, marketplace, kind of like, you can think of it as the eBay for expensive apparel goods. The third is going to be a very recent example, Lyft, which has been all over the news. And for those who've been following the stock a little bit more closely, they just reported earnings yesterday. So happy to talk through that a little bit. And I'm going to give a teaser for an analysis that is just about done. We're putting the finishing touches on it right now for Slack. I don't know how many people on the line have used Slack in the past. I'm a very voracious user of it myself, and they've made the news because they're expected to IPO next month. And there's been a lot of questions about the path to profitability for the firm. So we've done a deep dive into them. So I'll be sharing a little bit of that today. So that's the roadmap. So let's start with Blue Apron. So again, the context of this story is earlier, this was around the time actually that I was defending my dissertation. I'd finished defending the dissertation, and it just so happened that that was when they filed their Form S-1, which is what companies file before they go public. And the story that they painted in the S-1 was basically one of a market leader in an industry that's very rapidly growing. So they had more than 50% of the entire market. So whenever a dollar was being spent on meal kits in general, more than half of that dollar was going to Blue Apron. And even though the industry itself was relatively large, it still was very small as a percent of online grocery sales and of restaurant sales. And so what they were saying was basically, if we have 1% of the online grocery market and we're able to grow that to 2%, the online grocery market is barely going to feel it, but it's going to double our category. And if we're kind of the number one player in the category, then we're going to be able to basically ride that wave and become profitable in the future, even though we're not necessarily profitable right now. What was interesting was, even though they disclosed all of these kind of very optimistic, very flattering data points about their revenue growth, they didn't actually disclose anything about their customer churn. But I was able to kind of calibrate a model of the sort that I just talked about, model for acquisition of customers, model for retention, model for order rate, model for basket size, and calibrate that to all the data that they did disclose and triangulate my way into what the company's retention profile was. But before I get to that, the first thing that I wanted to do was say, I've got this model, does it actually fit the data well? And I think that's one of the key distinctions that we would draw between our approach and what you'll often see is people will talk about what a company's customer acquisition cost is or other measures like that that aren't directly provided by the firm, but they won't actually show you how well the model fits the data. And I think that's the first kind of bar that needs to be hurdled before we can say, all right, I feel pretty good about the model. What's it telling us about the underlying health of this business? So essentially, we took all those data points that we trained our model on, and we said, how well does our model infer those data points historically? And whether we look at the number of active customers that Blue Apron had over time, the total number of customers that the firm had acquired over a multi-year period, or the cumulative amount of revenue that's generated per customer after customers have been acquired over different lengths of time, we found that our model corresponded very well to what we actually observed. So again, in these charts, what we're seeing, the blue bars represent kind of our model-based estimate of each of these metrics, and the orange bars represent what we actually saw. And again, this was basically using the methodology that I laid out in a paper with that Wharton professor I mentioned before, Peter Fader, that's now in the Journal of Marketing, kind of about CBCV for subscription firms. So I would definitely recommend giving this paper a read if you're interested in some of the more kind of nitty-gritty details of the underlying methodology. Obviously, probably not too appropriate for for the purpose of this webinar.
Dan, we had a quick question. Is there a way that you can measure a particular customer's influence or advocacy as a driver and how you're valuing within your framework?
So certainly in aggregate, that's all this model is about, is how many customers are coming in, and then after they come in, what are they going to bring to the firm? Revenue per acquired customer over time, and how that flows through into variable profits. So typically the firms themselves won't disclose a whole lot of data like that, except sometimes, as we can see in this bottommost plot, this is providing us a view of kind of the overall average revenue per customer over different windows of time. But typically a lot of the inferences that we'd like to draw, those we basically don't get to observe from the firm's disclosures, but they can come for free from the model I'm about to share.
Great, thanks.
Yes, these are just a few disclosures. Oh, and by the way, please, more questions are better. I want this to be as interactive as possible, just so that you feel like you've got a good understanding of what's going on here. So again, we feel pretty good about the model's validation. We think it fits the data well, and so hopefully that allows us to trust some of the other inferences that the model is able to provide us, as I mentioned on the previous slide. So one of the big things that I was able to infer was, what is the company's retention curve? Now, the retention curve, for those who aren't as familiar, it's basically when you acquire a group of customers and then roll forward the clock a certain number of months, what % of those customers are still going to be with your firm? Obviously, 1 minus that is going to be the proportion of your customers who have churned over time. And what we can see here is that in month 1, about 45% of the customers will still be with the firm. So the other 55% will have churned. Those are probably all customers that came in just to get the promotion. Blue Apron, they were a very heavy user of promotional discounts to bring in new customers. And then troublingly, kind of the retention curve continues its decline in subsequent months. So, one of the figures that I had highlighted back when I originally put out this work was, after 6 months, only 28% of customers that had began service were still with the firm. The other, call it 70%, had churned. That's a lot. And it's very hard to build a durable business when you're churning out that large a proportion of your customer base. You can still have a very good business, but the other numbers would need to work. You need to not spend very much to bring customers in, and hopefully you need to get a lot more out of them while they're still with you. And that's kind of one of the other issues, is that the customer acquisition cost was moving in the wrong direction. So I was able to infer month by month what the company's customer acquisition cost was. And what we can see here is that from 2014 until, call it, the end of 2015, even into 2016, they were spending between, call it, $50 and $80 to bring in new customers. And obviously the economics of the firm are going to be different if you're spending 50 to 80 bucks versus if you're spending 125 to 150 bucks to bring in customers. Unfortunately, that's what we saw in the run up to the IPO. So they're going to IPO, and what we saw was they were spending tons and tons of money to acquire new customers, and it was driving their customer acquisition costs through the roof, upwards of $150 by the end of Q1 2017. And unfortunately, the amount that they were getting after those customers had been acquired in net present value terms, I'd inferred to be about $133. So again, 133, it's not a bad figure if you're acquiring customers at a cost of $50 to $60, but at $130, you're not making any money at all. And in fact, in the most recent quarter, we inferred that they were burning money to acquire customers. They were spending more than they were getting back afterwards. And so that was a bad sign. So I kind of put that work out there, and it got a whole bunch of press. It was in the Wall Street Journal a few times, and pretty much all the other major financial news media, as well as media more generally, including the New York Times. And it even got some response from executives at Blue Apron themselves. So this was a quote from the CMO acknowledging the work. It was actually a subtle jab at their competitor HelloFresh, but and unfortunately, Jared is no longer with the firm. He was fired as part of the last round of restructuring that the firm's been doing. Then there's a stock price reaction. Oh, I don't know if this means there's a question.
Yeah, we just got one. In calculating customer acquisition costs, is this simply sales and marketing, or were other costs factored into consideration?
This is just sales and marketing. And it's a very good question, especially because different companies can define terms differently. I'd say just dividing sales and marketing by the number of customers acquired is it's the most standard definition that's used. But again, as we're going to show actually with Lyft, they account for customer acquisition costs in a kind of unique way. So it really does pay to think about that question very carefully.
Great, thanks.
Yep. Actually, that's how Blue Apron defined their CAC in their S1 itself. So they actually had a figure in their S1 filing saying our CAC is X, and they said that their definition is sales and marketing divided by customers acquired. So this is consistent with their definition. Yeah, so Blue Apron, they've had a rough go of it in terms of the stock price. They originally had a price target of $15 to $17 for their IPO. They ended up having to cut that IPO price to about $10. And even that was a great price relative to where they are now. The last I checked, this was as of yesterday, end of day, they were down a further 90%. So they've had a really tough time. Their former CEO is no longer with the firm as well. And even that CEO's replacement CEO is also not longer with the firm. And so now they're trying to right the ship. So I did a quick update. Oh, I don't know if this is another question.
No, you're good.
Oh, great. Yeah, so I did a quick update just to, kind of check back in. Obviously, all the analysis I just shared, it was kind of current as of Q1 2017. A lot of time has passed since then. So as of Q3 2018, I went back in, reran the full model, and just took a look to see what it implied. And what was interesting was, for one, the model continued to validate well, whether we were looking at active customers, which is what we see over here, the number of total orders, total revenues, those all, the model-based estimates continued to track well what we actually saw. And what it implied was the company's retention curve was about the same. So again, just kind of keying in on that 6-month retention figure, that was still identically 28%, just by chance. It's not always going to be that way, but that's what happened to be true. The tough part is their customer acquisition cost had continued to go up. Now, this figure, it tends to vary a lot by season. And so to smooth out the seasonality, This chart in the bottom right, it shows kind of the rolling 12-month average. And again, that's just a way to get a sense for how the baseline is evolving, smoothing out those seasonal fluctuations. And what we can see is as we move to Q3 2018, the CAC had still been moving up, and it was on the order of $150 now. And that's on a rolling 12-month basis. So this is no kind of one quarter fluke. So this is an example of a firm that in some sense is upside down. Now, there's a lot of things that they're trying to do. I'm very happy to talk through those, but again, it's just going to be much harder for them to make the economics work when they're spending this much money to bring new customers in the door.
Dan, we had a question about the CAC. If it's higher than the SaaS revenue, but the customer data acquired will fuel a more lucrative predictive analytics, is high CAC bad?
All else equal, high CAC is bad.
Okay.
I would rather spend less than more, but obviously all else is not equal. There
Okay.
can be times if you have a very healthy customer valuation after they've been acquired, I may want to spend more on customer acquisition, even if it increases my CAC, if I'm able to bring in that many more customers that are also profitable. So the difficult part with Blue Apron was we were kind of bumping right up against the value of customers.
Mhm.
But as we're going to see in the next example, that need not be the case.
Great.
But yeah, it's a very good question. So I've written a number of things about Blue Apron. There's an HBR piece, as you mentioned it in the intro, definitely a nice high-level overview of the methodology, specifically focused on subscription businesses. And I even wrote an HBS case study with a University of Michigan professor by the name of Eric Schwartz. So definitely, if you're interested in this, check it out. So now I'm going to kind of pivot and move from a subscription firm to a non-subscription firm. The same sort of framework applies, but we need to use different statistical models to be able to kind of capture customer activity in a valid way. And the big distinction is, as subscription firms, we know when customers churn. In non-subscription firms, we don't know that. Essentially, we're going to have to infer it from the fact that customers haven't made purchases for a while. So we call that latent or unobserved attrition. So I've got a separate paper also with Pete Fader, kind of laying out the methodology for non-subscription firms. I'll provide a link to it at the end of this deck. But this was kind of a nice, more recent example bringing this methodology to life. So again, Farfetch, you can think of them as the eBay of expensive stuff. They were growing very rapidly at the time that they filed their pre-IPO filing. But again, as we saw with Blue Apron, revenue growth does not tell the full story. We need to really kind of go beneath the surface and try and see what it implies for the unit economic health of the firm. So that's what we did. And the nice thing was Farfetch disclosed a really nice amount of customer data in their filing. So some of the metrics that they disclosed were fairly standard for non-subscription firms. For example, the number of active customers over time, which is just the number of people who've placed at least one order over the preceding 12 months, the number of orders that were placed, and they disclosed something that they called cumulative lifetime value to CAC. Unfortunately, their definition of lifetime value is not correct. Lifetime value should truly be a lifetime value. And by that, I mean a long-term projection of how much customers are worth over basically the entirety of the relationship with the customer. And what they're showing over here is something actually akin to what I showed with Blue Apron. It's kind of over the next 6 months worth of activity, this is how much profitability customers are bringing in relative to their CAC, over 12 months, over 24 months, but not, again, over the entire duration of the relationship, which is why we see each of these figures from that leftmost data point to the rightmost data point moving up. It's because as we expand the window of time that we observe customers for, they're doing more stuff with us. And so essentially the numerator is going to be getting bigger while the denominator is staying the same. But we can calibrate our model off of what this implies the activity was for customers of this firm over different windows of time. So that's what we do. And perhaps most importantly, they disclose something that we've endearingly called the customer cohort chart, which is also, we kind of shortened it to C3. And what it's showing is it's cohorted data. And specifically here, it's showing the amount of business that was placed by far-fetched customers over different cohorts. So, for example, take that 2012 cohort. Those were all customers who made their very first purchase in 2012. And it's saying within that cohort, how much business did that cohort place in future years? So pink always represents kind of the activity of a cohort in their first year. And then each of those other colors represents kind of the repeat activity in future years. So that black strip represents all of the activity of the 2012 cohort in 2013, 2014, 2015, et cetera. And the fact that it's remaining so thick is an indication of very strong repeat business at the firm, even 5 years in the future, which is very impressive and a nice sign. But obviously, the key is going to be to kind of use this sort of information and glean from it what it implies repeat behavior is along the lines of the model that I described at the beginning. So that's what we did. And again, as with Blue Apron, we want to make sure the model fits. And the model, a very simple model, fit quite well. So what we see on the left over here, the left column, is basically the C3 chart. The top left represents the actual data. The bottom left represents our model-based estimates of that data. And it's very hard to tell the difference between those two. Those are very consistent with each other. And then the top right and the bottom right, those are just kind of expected versus actual active customers and orders. Whether we look at those or revenues or anything else, even the LTV to CAC chart, all those figures were quite consistent with what our model would have expected them to be. And in fact, we actually calibrated very well to data points that we didn't even train on. So our model, obviously one of the key pieces is customer acquisitions. We did not train our model on these 3 data points, and yet our model was able to infer them nearly perfectly. So first, the company had said they acquired more than 240,000 customers by the end of 2013. Our model had inferred 248,000. The third data point, it's they'd acquired 2.3 million plus customers as of June 2018. Our model said 2.4 million. So again, even for data points that we're not explicitly getting to see, we're capturing them very well, which again gives us confidence that we can trust some of the other inferences that we're drawing from the model that are also not disclosed by the firm. And that's what we're going to focus on next. So as with Blue Apron, let's look at their retention curve. Now again here, this is a latent retention curve because we don't actually get to observe when customers churn, but it tells actually a somewhat similar story to Blue Apron, that there's kind of one group of customers, they make that first purchase and they say, nah, this isn't really for me, and they drop out. And that's kind of why we see that big drop from month 0 to month number 1. But then after that, we see that it stabilizes and it's starting to go pretty flat, that essentially there's a lot of people who have very kind of high loyalty to the firm, and they're going to stay with the firm for a multi-year period. The other thing that we can see, which we did not see at Blue Apron, is that basket sizes were large and growing. And so basically when customers place orders, they're spending north of $300. And in fact, as the tenure of those customers improves, they tend to spend more when they do place orders over time. At Blue Apron, we saw the reverse. People tended to order less and spend less. And also, just in terms of monetary value, these are some very large purchases, which leads to a lot more incremental profitability when far-fetched customers make those purchases than kind of a perishable food product like with Blue Apron.
Dan, we had a question on, are these predictions in or out of sample?
These predictions are of a new cohort, so they are out of sample.
Okay, great.
Yep, so this is all going to be kind of figures current as of the most recently acquired cohort. So again, like this chart over here, this is the June 2018 cohort. So it's saying, that was kind of our most recent filing. Let's take the customers that they just acquired and let's see what the model implies for those people, just to kind of get a sense for, where we are literally right now. So what this is showing us is after they acquire a cohort of customers, there's going to be some amount of revenue that they get from that first purchase, and then there's going to be a stream of repeat purchases in future quarters. And what we see here, which is again what we always tend to see, in quarter zero, all customers have made a purchase. And so the revenue per customer is much higher than in future months. It's about $300. After month zero, this is nothing but repeat purchases. And what we see is there's kind of this drop down, and then it kind of stabilizes at about $80, and then it kind of starts rising again. And again, this is a very nice sign of the kind of the sort of repeat behavior that we're able to get from customers after they've been acquired, which we could kind of see from that black bar that I showed you on the previous slide in the C3 chart. And so when we kind of take this projection, we net present value it against the kind of the contribution profitability that underlies these revenue figures, we get a net present value on the order of $1,000. But no matter how we cut the numbers, even when we were trying to be pretty conservative about their margins, we were still inferring, call it north of $500 per customer. And that was just much larger than the amount that Farfetch was spending to acquire customers in the first place. So they were spending about $100, and it's been relatively stable over the past handful of years. If anything, the trend had been slightly down. And so we had a company where, again, they're spending $100 to bring customers in. They're earning $1,000 after they've been acquired. So that represents a customer lifetime value of about $900, which is about a 900% return on the amount that they were spending, which is a very nice return.
Dan, how do you estimate contribution margin for Farfetch and get comfortable with fixed cost coming down as a percent of revenue?
Yeah, it's a very good question, and it definitely pays to run sensitivity analysis. One thing that's always going to be variable, typically, we start with the gross margin. Most of COGS is going to be variable kind of by construction. And then we assume some amount of support costs, which often is considered to be an operating expense, that's variable, and even some proportion of kind of general and administrative expenses. So, again, we want to get a good view of what the true effective variable profitability is. And so we'll layer in those numbers. But certainly, especially for Farfetch, one of the big concerns about them is that their SG&A is quite high. And so, so we ran the numbers a few different ways, and that's why when I was mentioning the post-acquisition value, depending on what your assumptions were, you could get somewhere between 500 and 1,000, not necessarily just 1,000.
Great, thanks.
The good thing about this framework is whatever we don't consider to be a variable cost, we consider to be a fixed cost. And so when we're thinking in terms of a DCF model, they're still spending that money. And I think that's one of the nice things about this framework relative to a CLV framework. Oftentimes when you're doing a CLV analysis, what costs you put in, what costs you don't put in can have a dramatic effect on CLV. And those other costs is as if they just disappear into the ether. And here we're saying, no, that's still important. The fixed cost base of the firm is, it's an important piece of how we end up at fair valuation. But it has to show up somewhere. All right, so so to get we want a revenue forecast. And instead of just kind of putting our finger in the air and saying, GDP is going to grow by 5% this year. And so, let's just take their historical growth, make some adjustment for the macro conditions, et cetera. We're going to do it from the bottoms up. So we're going to take our forecast for customers acquired over time, which is what we see in the top left over here. We then model customer retention, the number of orders per customer while they're alive, and the amount that's spent on each order. And that's what's going to get us our revenue forecast. And then we run kind of a very standard DCF model, which we then sensitize to come up with scenarios about what the fair valuation of the firm might be. And we'd inferred a fair value of about $20 for Farfetch. And so we put an analysis out there. This was my firm, Theta Equity Partners, on our blog. And we thought we had a really punchy conclusion because at the time, of their F1 filing, which is when we did our analysis, they were targeting an IPO price range of $15 to $17. And so we were coming in north of that. Unfortunately, or fortunately for them, they revised upwards their IPO price to $20, which ended up being almost kind of smack on the money what our fair valuation estimate was. And then on the first day of trading, they subsequently popped an additional 50%. But in general, the conclusion here was constructive, both on their unit economics and for their kind of overall valuation. Again, we got some press in CNBC and other venues like them. So this is just kind of one example of one of the articles that had come out. And since then, we've seen the stock, kind of be above, sometimes fall slightly below, but generally kind of hang around the IPO price until somewhat recently that they've kind of more sustainably moved above that $20 IPO price on news of some very promising partnerships that they've been developing. So hopefully, both with Blue Apron and with Farfetch, it's fair to say that we called the direction correctly. The third example is Lyft. Obviously, I don't know how many people have actually used Lyft. I assume it's a very large number of the people on the line. But for those who don't know, they're basically one of the two largest ride-sharing companies in the world, behind Uber. They're ride-sharing only, so they don't have a food service, and they're US only. They're growing very quickly, but their losses are also really quite large. So they had something like a 40% operating loss as a percent of their revenues in 2018. And so, as with both Farfetch and with Blue Apron, there are questions about the path to profitability. And that's exactly the sort of situation where CBCV can shine. So we took a very deep look at them. And the nice thing was, as with Farfetch, a lot of these charts are going to look very, very familiar. So they kind of focused most of their disclosures on the rider perspective. So they provided the number of riders who were active over time, the total number of rides that had been placed, and the amount of revenue that Lyft was getting when rides were taking place. And they also provided the C3 chart. Instead of providing it by gross merchandise value, which is what we saw for Farfetch, they disclosed it for the number of rides that were placed. So again, this is saying, just to kind of interpret some of these numbers, take all the people who made their very first ride in 2015, those customers had done 25 million rides. And then in year two, they placed almost 50 million rides. And then in year three, they placed 60 million rides. And so in general, what we're seeing is Lyft, they acquire a cohort of riders, and over time, the number of rides that those riders place tends to increase, which is a heartening sign, all else being equal. They didn't provide any information about the driver's perspective. So I would have loved to have seen a C3 chart for the drivers or some sort of retention measure, but they provided nothing about that at all. So we have to do with what we got, and so we did. So we just kind of took all the data that they disclosed, primarily about the riders, and ran it through the same, almost exactly the same sort of model that we used for Farfetch. And then again, we want to validate the model. So we looked at all those disclosures that they did provide and got our model-based estimate of those disclosures and found that the model corresponded really quite well, whether we were looking at active riders, which is what we see on the top left, revenue per active rider, revenue, or the big one, the C3 chart. So on the left, we see the actual C3 chart. On the right, we see what we expected the C3 chart to be. And again, they're nearly indistinguishable. And as with Farfetch, there was one data point that we didn't calibrate our model on that we ended up inferring really quite accurately. They said they reached their millionth ride sometime in 2013. We'd inferred that they hit that kind of right around the middle of 2013. So a little bit easier for us to hit this target, but nonetheless, it makes us feel good that along all the various dimensions, we're able to capture the data pretty well. All right, so sorry, I don't know if that's a question.
No, that was just me being really impressed.
Oh. Yes. Yeah, we look at these charts And it's gotten to the point, first, when we see these disclosures, that just, it makes me feel good inside. I'd
Yeah.
like to see C3 charts. And then when we see the charts fit this well, it makes me feel even better. So
Yeah.
I don't know if that's a bad sign for my mental health, but hopefully it's a sign that the models are doing what we hope that they would do.
Yeah, you're going down the right road for sure.
So this will sound like rinse and repeat, but kind of as with the previous two examples, the next big question is, okay, the models work. What do they tell us about the health of these firms? And at Lyft, what it basically inferred, somewhat similar again to the previous two examples, is there's kind of variation in the loyalty of riders. And so in that first month, we see kind of a fairly sharp drop off in the number of people who stay with the firm, but then we see it stabilize again. And we infer that there is kind of this kind of very long-term loyal segment that's relatively small, but that will drive a lot of the goodness of the customers. So we don't want to ignore that. We don't want to treat everyone the same. What we want to do is allow and embrace the fact that there are differences. And then hopefully, if we're inside the firm, we can exploit that information to identify what it is that makes our best customers so different from everybody else. So another insight that we could glean was as riders have longer relationships with Lyft, they tend to ride more. Again, this is actually kind of analogous to what we saw at Farfetch. And again, a nice difference from what we saw at Blue Apron, that people tend to do more with the firm the longer that they have a relationship with the firm. So as with Farfetch, we then translate that into kind of an estimate of how much customers are worth to Lyft on a net present value basis. And we infer that basically when Lyft brings in a customer, after they've been acquired, they're going to get about $50 back in variable profits, as we see over here. And they spend about, call it $30 to acquire customers. So again, both these figures are smaller than the figures that we saw at Farfetch, but even though they're smaller, the ratio of post-acquisition value to customer acquisition costs is reasonable, that they're turning a profit, and it equates to about a 70% return on their customer acquisition spend. And I guess the final thing that I'd note is when we look at their CAC, we see that it fell very sharply from 2016 to 2017, that they used to spend on the order of $50. And I think one of the big reasons why their CAC had fallen so sharply was a lot of people were migrating away from Uber. And so they were getting a lot of new acquisitions kind of for free, that a lot of people were kind of migrating over to Lyft, kind of in an attempt to kind of terminate the relationships with Uber. And so even though Lyft was actually spending more in sales and marketing dollars to acquire customers, they were getting that many more customers in return, which drove the ratio down. So this was kind of our view, constructive. At the same time, the lifetime value was not tremendously large, not the sort of ratio that we saw at Farfetch, but at least we could say that it was on the positive side, as opposed to flat or even negative at Blue Apron. And one of the things, as I mentioned, that drove this constructive view is that they have this 10% of their acquired customers that are really quite loyal to the firm. So actually, on 80% of their customers, we infer that they are losing money on them, that they're spending more to bring them in the door than they're getting back in return in net present value terms. But we can see that rightmost bar in this chart basically showing us they have got kind of a solid 14% of their customer base that is worth $100 or more in post-acquisition value. And so they're going to be kind of what drives the bull case at Lyft. So when we translate that into a revenue forecast in exactly the same way that we did at Farfetch, we end up with a fairly constructive view of where revenues are going to go. This is basically our revenue forecast 2019 until 2025. And we can see, again, continued very steep, very sharp revenue growth. The tough part is when we want to translate that into overall valuation, that the fact that their fixed cost base is so large, we infer that they're only going to start turning a profit, call it in 2022. And so when we just take the net present value of all the future cash flows at Lyft, we infer a fair valuation for the equity of, call it 5 to 7 billion, which was certainly a lot lower than what they ended up IPOing at. But in general, I think the conclusion here is that the valuation was not supported by the fundamentals that as we could see them. Even when we ran some fairly optimistic growth assumptions, for example, that they would expand internationally and pretty much penetrate the international market as well as the US market. So we tried to be as optimistic as possible, barring kind of outlier scenarios. And again, they did not get us anywhere close to what they ended up IPOing at. So we kind of put that analysis out there. It ended up getting featured in a number of news outlets as well, including the Financial Times and the Motley Fool. And those who've been following the stock know, in some sense, they've been a black eye in the recent kind of slate of IPOs. They went down on day one, and they've continued to go down since. And they just reported earnings yesterday. And even though a lot of people are focusing on strong revenue growth, analysts had forecasted earnings per share of, call it -4, that they would lose about $4 a share. They end up losing $9 a share, so more than double the loss that analysts had forecasted, and that's pretty steep. That's about 15% of their equity valuation. And the stock, the last I checked, it was down 6% just today. So again, we're a little bit bearish on this one. If they transform themselves and they develop a fleet of automated cars and their gross margins go to 75%, sure, that their valuation would be more than justified in that scenario. But doing that in a relatively small number of years, I'm not sure that I would bank my investment on that having to be true.
We have a question that came in. Does the misalignment between valuation with underlying unit economic fundamentals versus what the public markets are currently valuing these unicorns make you believe we're running into a unicorn bubble?
It's a good question. I mean, certainly valuations have been on the higher end, but I would say, Farfetch, they were a unicorn, and we were still constructive on their stock price. So at least in that case, I think there can be examples of companies where the fundamentals would support it. I would say it is probably fair to say valuations are probably coming in higher than they should be in general. So I share those concerns.
We had another question. Do you take any short or long-term positions on the companies you analyze?
No. Yeah, and that was especially poignant for a couple of the companies that we analyzed in the paper that laid out the non-subscription valuation methodology. We had empirical examples comparing Overstock and Wayfair, and after we put out the results on Wayfair, they kind of accused us of working for a short seller or having some other incentive, and we wanted to be absolutely clear that we've never been paid directly or indirectly, and we've never established a position in any of the companies that I've mentioned.
Great, thanks so much.
Yep. So the next one is going to be Slack. As I mentioned before, a lot of you have probably used them before. They're set to IPO next month, I believe, and they've got a nice kind of global user base. They've got a run rate revenues of about 500 million per year, and again, their losses are somewhat large. So one of the big questions is, do they have a path to profitability? And while I'm not going to share our conclusions yet, please follow me on LinkedIn and or Twitter, because we're going to be posting the results hopefully sometime before the end of the week or on the weekend. So I'd love to be able to share those results with you as soon as we have them. What I can say is we have a fully validated model. So again, as you can tell, it's almost robotic. We have a very kind of standard procedure now, where step one is validating a model to make sure that it fits the data well. And then step two is seeing what those results imply for unit economics. And then step three is seeing what those unit economics imply for the company's fair valuation. So I'll just kind of share a teaser of step one. So the revenue model, it forecasts very well. The reason that that leftmost bar is so much larger than all the other bars is because that's an annual revenues figure for 2017, and all the other figures are quarterly numbers. The number of paid customers, our model tracks very well. And the nice thing is Slack also provided the C3 chart. So I was super happy to see this in their S1 filing. And we can see whether we're looking at the actual one or a model-based forecast, the two are nearly indistinguishable from one another. And kind of harkening back to Farfetch, and we kind of focused in on that black strip representing that 2012 cohort. Over here, we can see the same sort of effect by looking at the blue. Those are basically all the people who were acquired over the course of 2015. And we can see that in subsequent years, the business from them is just growing, growing, growing. So this is a very nice sign of expansion of revenues in future periods. And they also provided some really helpful data points about the number of paid customers that are very large. So they've got a lot of kind of small fish, and then they have a much smaller number of customers who are bringing in over $100,000 in annual recurring revenue. And we track that figure very well, as well as the company's net dollar retention rate. So we try to pull in as much data as possible and show that we were able to recover it, and we do. So so hopefully when we provide the insights, we can trust those. They will surprise, and I think you'll find them to be very interesting.
Oh, that's a great teaser.
It's like a Marvel movie. Sorry. So yeah, so in conclusion, we think that this is the future. We think that by kind of incorporating best of breed marketing science models into finance, that we can just do the finance game a bit better. We're not going to try and replace the finance model. We're just going to try and do some aspects of the forecasting process a little bit better for some of those key line items. Please check out my firm if you're involved with investments, or if you're a company that would be interested in getting a reading yourself. We've done dozens of inside-out analyses where we actually have the transaction log as opposed to just these summary measures of the sort that I just disclosed. And again, I think my hope is that 10 years from now, basically that CBCV becomes boring. It's just basically what people do to do valuation. And in the same way that no one really kind of bats an eyebrow when they talk about DCF modeling, I think in the future, people are going to talk about CBCV in the same way, that you look at a company like this, and this is just how it's done. So we have a long way to get there, but hopefully we've taken the first couple of steps.
That's great. Thank you so much.
Yeah, just a few resources over here. Got links to the papers. Again, please connect with me. And obviously, as Lane had mentioned, there's the YouTube, but also if you wanted a copy of the deck, I'd be very happy to share that with you too.
Great, thank you so much. We've got a handful of questions that have come in. The examples you've used are primarily B2C. Can the same approach be used for B2B companies? And
Yes.
what differences should we look at while doing this analysis for B2B?
So Slack is a B2B, and
Okay.
yeah, and obviously the validations continue to be good there, but certainly what we tend to find is that you tend to spend a lot more to acquire customers, and you tend to get back a lot more after they've been acquired. So whereas when I have my B2C cap on, I'm thinking about CACs of between, call it $30 and $150 per acquired customer. The norm for B2B is going to be, you're going to see CACs in the thousands. It's just people spend more. But every relationship, instead of requiring, Joe from down the street, you're acquiring McKinsey. And so oftentimes those relationships are much more valuable to those firms. The other thing that you tend to see with B2B that you may not see quite as strongly the the thing that you would see in B2B firms that you may not see as strongly in B2C firms is that very strong revenue expansion. So in particular with SaaS firms, that chart that I showed, the C3 for Slack, that is actually somewhat common. If you look at the C3 chart for Atlassian or for Zoom, presumably, you would see a very similar dynamic that there's just really strong growth or expansion of relationships after customers have been acquired. Whereas in B2C firms, oftentimes you'll see those bars get thinner.
Great. We had another question following up for Slack. Are you planning to include the effect on customer acquisition due to PIP chat going away?
Due to
PIP chat?
PIP chat.
I think that was an early competitor, possibly.
Oh, well, so certainly competition is embedded into, it's going to affect all the numbers. So whether we're talking about the size of the applicable market or the penetration of that market, that's where competition is going to basically either remove portions of the applicable market or lower the proportion of people who will eventually be acquired. So one of the things that we did with Lyft was vary our assumptions on the size of the applicable market to account for direct or indirect competition. And certainly we're going to do the same thing with Slack.
Okay.
We
also have...
Yeah, I think one of the big questions with Slack that I've heard is I hadn't heard of PIP chat, but Microsoft Teams, that people are saying that Microsoft Teams will be the Slack killer, and maybe, maybe not.
Uh-oh. I'll have to stay tuned. We had another question looking at your Lyft work. Has that inspired you to do any work for Uber? Do you have any interest in doing direct comparisons for companies like Uber versus Lyft?
We wanted to, and I'd posted a message on Twitter about how Uber didn't provide us enough information in their S1 filing to allow us to do that comparison. They didn't provide any C3 chart at all. Nothing about the drivers, nothing about the riders. And even though they provided a lot of interesting data, there's very little about the riders. And so unfortunately, we can posit a model, but unless we have rich enough disclosures from the firm itself to bring it to life, we just can't get started. So unfortunately, we can't do that because lack of disclosure.
Yeah, you tried. Thank you so much, Dan. This was a wonderful presentation, and I think a lot of people got so much out of it, and now we're all going to be on the edge of our seats waiting to hear about Slack. I'm going to share this recording with everyone who's registered, as well as Dan's contact information, his Twitter and his LinkedIn, so you can stay tuned. Thank you all so much for participating, and again, please do check out engage.emory.edu for more events in person and through our digital platforms. Thank you so much, Dan. I hope you enjoy commencement activities.
I'm grateful for your thinking of me. So very happy to do this, and I'm happy to do it again if we've got a new set of companies, maybe.
Oh, we'd love that. Let's do a round 2 soon.
Well, looking forward to it.
Great. Have a great afternoon, everybody.
Take care. Bye.
Bye-bye.